How are commodity ETNs different from direct ownership? Imagine holding a shiny gold bar in your hand or owning a barrel of oil. Now, picture investing in a financial product that tracks the price of those commodities without ever touching the physical asset. That's where commodity exchange-traded notes, or ETNs, come into play. They are a type of exchange-traded product, which means they trade on stock exchanges just like stocks or bonds. But how are they different from owning the actual commodity? Let's break it down. When you own a commodity directly, you have physical possession or a futures contract that gives you a claim on the commodity. For example, owning gold bars or wheat bushels means you can store, sell, or transport them. You are directly exposed to the price changes of that commodity. Commodity ETNs, on the other hand, are unsecured debt instruments issued by banks or financial institutions. When you buy one, you are essentially lending money to the issuer. The issuer promises to pay you based on the performance of a specific commodity index or benchmark after deducting fees. You do not own any physical asset or futures contract. Instead, your investment is a debt obligation. This means if the issuer faces financial trouble or goes bankrupt, your investment could be at risk, regardless of how the commodity's price moves. Owning physical commodities involves storage costs, insurance, and logistics, which can be complicated and expensive. ETNs avoid these issues because they do not require physical handling. They also tend to have simpler tax treatment, with gains taxed only when you sell or redeem the ETN. This can make them more tax efficient than holding physical commodities or futures contracts. Market access is another difference. Physical commodities can be hard to buy and sell, especially in small amounts, and may involve high costs. Futures contracts need active management and margin accounts. ETNs provide a way to easily buy and sell exposure on stock exchanges, offering liquidity and convenience. When it comes to tracking performance, physical commodities and physically backed funds usually follow the actual market prices closely. ETNs aim to replicate the performance of the underlying index, but they might experience slight differences due to fees or the way they roll futures contracts if they track futures-based indices. So, in simple terms, investing in commodity exchange-traded notes offers a quick, easy, and less costly way to get exposure to commodities without the hassle of physical ownership. But remember, they come with issuer credit risk, meaning if the bank or issuer fails, your investment could be affected. Direct ownership of commodities gives you actual assets and avoids issuer risk but involves storage, logistics, and management costs. Your choice depends on how much risk you're willing to take and whether you prefer convenience or direct control over physical assets.